In many cases, mezzanine loans can take a borrower's total loan-to-value ratio up to something like 75% or 80%, which can make it easier to raise a smaller amount of equity, but this also comes with the reality of much tighter cash flows and less room for error. So to apply this to our sample deal scenario, let's say that the senior lender signed off on a mezzanine lender funding 10% of the total capital requirements, or $1 million, bringing that equity requirement down to just $2.5 million and only $125,000 that now needs to come from the GP. But again, this is still more than what that GP has available to contribute. So to make up the difference here, investors will sometimes move on to an even more expensive capital source that often acts as a hybrid between debt and equity financing, and this is preferred equity. Preferred equity investors have payment priority above common equity investors, but they'll be behind both the senior lender and the mezzanine lender on the deal. And preferred equity payments are often structured as a mix of both current pay, which essentially acts as a monthly payment based on an interest rate, and accrued pay, which builds up over time and ends up being owed once the property is sold. This can often lead to all-in rates in the 15 to 20% range for preferred equity capital, which is why in most cases this is not used by investors unless absolutely necessary. But for the purposes of our example, in this case, this investor just doesn't have access to an additional $25,000 and a preferred equity provider that could contribute another 10% of the capital requirement would finally bring that GP's required equity contribution down below that $100,000 mark to just $75,000.